All right, today we're talking about something I like to call your financial armor. We're going to break down the Dodd-Frank Act, a really powerful set of rules that's designed to protect you, yeah, you, every single time you borrow money.
So what's stopping another 2008-style financial crisis from happening all over again? I mean, it's a huge question, right? And a big part of the answer lies in this one massive rule book that completely changed the game for banks, lenders, and most importantly, for you.
Okay, so to really get why this rulebook was so desperately needed, we've got to rewind. Let's go back to that moment when the old system just broke. The problem was huge, and it hit everybody.
You know, at its core, the 2008 crisis was really a story of broken trust. You had lenders handing out these incredibly risky, predatory loans to folks who, let's be honest, just couldn't afford them. And the fallout from that, it was a tidal wave that went through the entire global economy.
So, in the aftermath of all that chaos, the government had to step in. They basically decided to write a whole new rulebook from scratch. And the number one goal was to make sure a disaster like that could never, ever happen again.
And that rulebook, that is the Dodd-Frank Act. It was passed back in 2010, and its mission was crystal clear: rein in the financial industry, put a stop to all those dangerous lending practices, and most importantly, put a protective shield around consumers like you and me.
Now, this is so important. The Act didn't just create a bunch of new rules and then walk away. Nope. It created a referee. That's the Consumer Financial Protection Bureau, or the CFPB for short. They were set up to be the official watchdog, the ones on the field making sure everyone in the financial world is actually playing by the rules.
Yeah, this really sums it up perfectly. Honestly, the easiest way to think about it is this: the Dodd-Frank Act is the parent, and the CFPB is the child it created to go out there and get the job done.
Okay, so what does all this regulation and these agencies actually mean for you? When you're out there trying to get a mortgage or some other kind of loan? Let's break down how these rules build up that financial armor we talked about, piece by piece.
All right, first up, and this is the absolute cornerstone of the whole thing, the Ability-to-Repay Rule. This is just common sense written into law. It says a lender simply cannot give you a loan unless they've done their homework and have real proof that you can actually afford to pay it back, period.
And they can't just wing it either. They are legally required to look at the whole picture. That means your income, your assets, your job situation, your credit history, and yeah, how much debt you're already carrying. They have to do the work.
So here's a great little memory trick for this one. ATR equals always test repayment. It's the lender's job, their legal responsibility, and it's your most fundamental protection.
Now, building on that idea, the Act also created this special category of loans called qualified mortgages, or QMs. Just think of these as the gold standard of home loans. They're designed to be safer, more stable, and they're automatically assumed to meet that big ability-to-repay rule we just talked about.
So, what exactly makes a QM loan safer? Well, they have specific guardrails built right in. For one, they can't have those super risky features like interest-only payments where your balance never goes down or sometimes even goes up. They also have a max term of 30 years, and a really big one, your total debt-to-income ratio, or DTI, generally has to be 43% or less.
And here's the quick and dirty way to remember this one. QM equals quick math. Think 30 years max, that 43% DTI cap, and absolutely no sneaky tricks. Okay, the next piece of your armor is the anti-steering rule. This is all about making sure the person arranging your loan is working for you, not just for a bigger commission. It makes it illegal for them to steer you toward a more expensive loan just so they can pad their own pockets. And the little phrase to lock this one in your brain is simple but powerful. Don't steer into fear. This rule is there to protect you from being guided into a really scary financial spot just for someone else's profit.
Okay, this next one is a really big deal. It's called the Risk Retention Rule. See, before 2008, a lot of lenders would create these super risky loans and then immediately sell off 100% of that risk to investors on Wall Street. They had zero reason to care if the loan was actually any good. Well, not anymore.
So now, for certain kinds of loans, lenders are legally required to hold on to at least 5% of the risk themselves. Now, I know, 5% might not sound like a lot, but believe me, it fundamentally changes the entire game.
Why? Because Dodd-Frank forces lenders to keep some skin in the game. It's as simple as that. When their own money is on the line, suddenly they have a very powerful incentive to make sure they're only creating good, safe loans in the first place.
Wow, okay, we've covered a ton of ground, right?
from ATR and QMs to skin in the game. So how in the world are you supposed to remember all of this? Well, and this is the really cool part, the Act itself gives us the perfect tool.
Check this out. The name itself is a mnemonic. Let's just walk through it letter by letter. D is for don't steer borrowers. O is for originator pay rules. The next D is for the DTI cap of 43% for those QM loans. And the last D is for disclosure of appraisals. Then we have F for fair lending oversight, which is the CFPB's job. R is for risk retention. That's the 5% skin in the game. A is for the ability to repay rule we started with. N is for no toxic loan features. And finally, K is to keep consumers protected. See? It's all right there, hidden in the name.
All right, let's bring this all home. Why does any of this stuff really matter to you today? Because this isn't just some boring history lesson about a financial crisis from years ago.
No, these rules are your financial armor. They're working silently in the background every single time you apply for a loan, making sure the system is fairer, more transparent, and way more stable. They are literally designed to empower you and protect you when you're making some of the biggest, most important financial decisions of your life.
So yeah, the system is without a doubt safer because this armor exists. But that brings us to one last question to chew on. Now that you have this armor, what are the new challenges? What financial dragons are still out there that we all need to be watching out for today?